AMD just lost about 30 billion in market cap. The stock sinked actually 17% right now. You can see it here. The stock is down almost 17%. The main reason is guidance, and we will see it in detail. But I have also discovered some interesting things in the filings that I wanted to share. So stay tuned. We're going to talk about all of these. So AMD stock has surged more than 100% in the past year, and this is why the slightest mishap can actually take it down, and this is what happened here. Now the chip maker dropped because of guidance, but you will see that the revenue they reported was 10.27 billion versus 9.67 that was the expected, and also they expect 9.8 billion in revenue for the first quarter, that's next quarter, versus the expectations of 9.38. So they actually surpassed the expectations, but some analysts had more in terms of predictions, like stronger guidance, and this actually hurt them, which is kind of weird because the guidance is still pretty strong. It's just that it has been skyrocketing so much, and the expectations are so sky high, as it's mentioned here, that even the slightest issue can take it down tremendously, as it happened here. Again, especially if you are up like 100% for the year. Now they have inked a deal with OpenAI in October because they are taking a 10% stake in AMD for getting their chips, basically for using their chips pretty much. So AMD is actually kind of subsidizing that with equity, with their own shares, and we will examine that in detail because this has implications for shareholders. Now, Oracle also announced that they are planning to deploy 50,000 of AMD AI chips. So AMD is actually trying to become really, really relevant in what is happening right now with AI, and I appreciate that. Now, their numbers, you can see that the P ratio has been going down. Outstanding shares have been skyrocketing since 2021, as you'll see, 2022 actually, and we will examine why exactly. You'll see exactly why this happened. Now, the price to free cash flow is down because the stock has been down, the stock price. Revenue, net income, total equity, and all that have been going down nicely through the years, with their margins getting a little bit suppressed here in terms of the actual bottom lines, for example, here. Now, the debt that the company has is very little, so this is nice to see. But if we examine the financial statements, you will see the story of a company that has been growing nicely, really nicely. And you will see that we're talking about revenue of 4 billion back in 2015, now 32 last 12 months, and actually really increased in the last 12 months, which is nice to see. So they're doing really well. Notice this line, the depreciation and amortization, and especially the amortization of intangibles into 2022. Remember this, 3.5 billion, now 2.3. You'll see exactly why this is. And AI actually has extracted all these values very nicely here in the tool. Net income has been also going up, which is nice to see as well. And you can see that some are variable to common as well. Some actually it's about the same here. Okay. Now the thing that we want to see is the cash flow a little bit, because you will notice that the company has been spending a little bit more in like stock-based compensation here, so spending a little bit more in stock, a little bit in depreciation and amortization, what I mentioned earlier, especially 2022, and we will see why. Capital expenditure suppressed, they don't spend that much over there, with about $1 billion now, which makes their free cash flow at about 4.5 billion. So they are doing really well here. Now, if we take a look at the company profile, we'll see the actual details about what we already saw here in cash flow, but we will see it in events. So if we take a look at the key events of the company, now you will see that AMD gives OpenAI warrants of 160 million shares that are tied to purchasing their own AMD Instinct GPUs. So again, subsidizing sort of like OpenAI to use their chips for their stuff, pretty much is what they're doing here. And the other interesting thing, remember 2022 that we saw earlier, again I'm gonna go compact, you will see that AMD completes a $50 billion Xilinx deal acquisition, as you'll see here, that closed. And this was a $50 billion in equity, so the company actually paid stock in order to get that. And this is why you are seeing the massive increase in outstanding shares back in 2022. This is what happened, the warrants is what happened there. So now you know the exact story, even with words here. Now, if we look at the AI deep dive, you will see some finer details, like the OpenAI deal that we talked about, export controls from the US government and China here, that the company is dealing with. All of these companies that are having implications with chips, obviously, and it's understandable. Now, you will see that one factory runs everything. TSMC, I talked about it in a video. TSMC is one of my top shares right now, top stocks to own, absolutely. with ASML, I think these are absolutely top right now because they're monopolies basically. Now, 25 billion in goodwill. Remember what we saw earlier with the company that they bought, and 17 billion in intangibles from past deals. Now, actually, the goodwill I will show you, 25 billion that you see here, I will show you as well. And they're also raising cash to chase AI growth, is what they're doing, of course, like all companies these days. Now, again, I forgot to show you the balance sheet here because you will see what the story was talking about. The goodwill here, that's been 24 billion, 24, 24, 25 here. Again, because of the 2022 acquisition of Xilinx. Now, the next thing to check, which is important, is the stock alerts, because they give us a graphical representation of what the company is doing, and I love this because I can very, very quickly see what's happening. Like the margins are solid, looking solid here overall, with some suppression in Q2. But capital efficiency of the company has been going down, and notice again this 2021. What happened there? The acquisition. And why is this down because of the acquisition, you're asking? Thank you for the question. If you take a look at the card, you will see what this is, and actually you can study it and see how it works, because the return on invested capital is about the capital that is employed for the company. And what is capital? Capital is equity plus debt. So equity plus debt, this is not debt, this is equity, because they actually spent shares. They actually gave away shares, warrants pretty much, which is shares, outstanding shares of the company, and increased their outstanding shares count, diluting shareholders. And so now, because the return on equity is equity plus debt, they had $50 billion in equity being applied here. And this is why this went down tremendously. So this is expected to be like a 1 here. There's a reason for this that we actually show and understand. But it's good to know, like we know it graphically immediately what is happening here with the company, which is fantastic. Now the margins are looking solid here overall for the company. The cash flow quality and the earnings quality very normal here with 1.9x. And yeah, the conversion looks strong as well. The owner earnings not a big deal here. The company is actually converting money that gets into the owner's pocket eventually. And 8 months of debt, the company has very little debt here. The share dilution is the thing that we talked about, and the stock compensation is normal, about 5%. Okay, it's a little bit moderate, I should say. But the share dilution, the company is basically unable to do enough buybacks to actually fulfill all the slots that they have taken, actually, with all the shares that they have already given away. So that's almost impossible to do. There's a lot of stock. But, so this is why the buyback quality is a 1 here, understandably. And the goodwill risk, again, you can very visually see 2021 was fine, 2022, a lot of intangibles here, for instance, added to the goodwill risk. Again, understandable. How much of the balance sheet is goodwill from acquisitions? And potentially you could have write-downs. Again, the company's acquisition of Xilinx is good. Nobody regrets it in AMD. It's just the repercussions of it, which happen in the books, and you can see it here visually. Inventory, a little bit of bloat increasing here, and I suppose they're making a ton of new inventory here. It's not growing as much as sales, is what this is saying. It's like a 3, so it's building a little bit, building up. They are not spending a lot in capex, so the depreciation is higher than the capital expenditures. Interesting, maybe they should be spending a little bit more here, but they are not. They are focusing on actually acquiring customers, is what I'm seeing with AMD here, getting deals pretty much. Accruals quality is also pretty solid here. This can be worrying if you have low numbers. You can have like an Enron type situation, so you have to be careful about this being a normal value. Depreciation adequacy, the company is nowhere near. Again, they are not spending a ton in capital expenditures, so yeah, it's expected. And obviously, they don't have issues in terms of bankruptcy. They're nowhere near that. And also, they're not cooking the books. This is what these two metrics tell us, which are very, very solid. Insider trading, I also want to kind of check a little bit because it can give us something about the discretionary, especially sales, which are not pre-planned sales. There are sales that can happen in 2 days, for instance. And so this requires some closer attention, but you will see most of these are actually pre-planned with the form pretty much filed before the sale. It's only one sale that was a discretionary sale. But for the most part, you'll see all of these are like pre-planned sales with many millions of dollars from the CEO and president of the company. All right, so nothing worrisome here. And the last thing I'm going to check. You see how we do a super fantastic deep dive here. We see so many things about the company. It's almost as if we're an analyst and we don't even need to look around. It's fantastic. By the way, you can do this yourself. If you take a look at stockaiinsights.com, there is a free account that you can join at any time. and I can promise that you will love the tool. It's really cool, really cool. So Stock AI Insights Lucky 13 is what I use. 13% is my required return usually, and these are the averages that the company makes, like a low, a medium, and a high scenario. I use 13% because that makes sense for an investor. For the most part, 12, 13%, something of that sort is a expected return. So this is going to be overvalued as expected. The company has been skyrocketing. But if you want to be closer to the WACC, for instance, which is more like an acquisition type estimation, it's not really what we want for returns. We normally want more, but because the company is actually making a lot in other areas, making up for the growth that they will be achieving in the future, you can actually accept something of a value of this sort, for example, like 150 and less, as we saw earlier. And so you can actually have a less required return just for this, expecting the company to actually grow tremendously through the years, which I actually like. At this kind of value, I would definitely be buying the company like a 150. Now it's a little bit expensive, but not insanely expensive. I could see the company growing through the years nicely. It is expensive, don't get me wrong, but it's like there is expensive and expensive. Like if you are buying a grocery store at a 20 multiple, 20 times earnings multiple, then it's extremely expensive. But these companies can really, really grow fast, and especially this kind of era, when you get them at a cheap price, it's actually, you have my attention when they actually go down. I would love to see some sort of a decline here even more for the company, which we could see. But yeah, over the long years, pretty much the many years, I see this one as being a solid opportunity, and I didn't really see issues with the numbers. Like, did you? Like, the sales have been looking nice. A little bit of weakness in guidance, and it's not even a weakness, frankly. It's just that they did not overachieve. Like, it's not a big deal, frankly, for me. But I love to see that the street takes it down, because it makes for buying opportunities that I can bring up to you guys. So thanks for watching. I'll see you soon. Bye bye.